unfortunately, investing is not the thing that's going to allow you to retire early. How do I know this? Because I've been a financial advisor now for over 20 years, and I've helped guide hundreds of families successfully into retiring. So I know it sounds controversial, but let me explain. I tell my clients that there's 3 rules in order to become wealthy. And the first rule is, I don't care how much money you earn, you have to spend less than what you earn. And the second part of that rule is, it's not enough to save, you also have to invest. So you're probably thinking, hey, Azul, doesn't that just contradict what you just said? Not really, because really what matters is time and money. Let me explain. So the first reason it's not investing is because it takes money to make money. And by this I mean, let's say you're a great investor and you're getting a 15% return one year and the market did 10%. You know, that's a solid return. In fact, you could do very well as a professional if you can outperform the market by 5 percentage points a year. But let's just say you earn 15% and you've got $1,000. That's your base. You know, you really didn't move the needle. You made $150, which is a nice meal and a bottle of wine at a restaurant, maybe. Probably not even that anymore. It's a nice meal. So it doesn't really move the needle. Now, if you got $100,000, you just earned $15,000. So that's starting to get there. But if you have $1 million, if you have that base, you just earned $150,000. And that does make a difference. That's money that you can use to support your retirement or to help people in causes that you care about. So the first reason that investing is not what's going to be what allows you to retire early is because it takes money to make money. Okay, the second reason, and it's kind of a secret, is investing really doesn't make many people rich at all. And why is that? Let me give you some more examples. You're able to save $10,000 a year and you get a 7% return on that. I'm not saying this is a risk-free investment, but that's your portfolio and you get a 7% return on it. How long does it take you to build up to $1 million? $10,000 a year, 7% return. Any guesses? Unfortunately, it's 31 years. That's a long, long time. So let's say we double. Let's say we save $20,000 a year and we get that 7% return. How long does that take for us to get to $1 million? You know, a lot of people would say half that time, right? Hey, so I'm saving twice the money. I should get there in half the time. Remember, at $10,000 a year was 31 years. Now it's 22 years. Okay, let's say we triple it and we save $30,000 a year. Surely we should be able to get to $1 million in 10 years, right? Saving $30,000. I mean, think about that. That's a lot of money. If your take-home pay is $150,000 a year, 20% of that is $30,000. So if your take-home pay is $150,000, you're probably making like $200,000 a year. That's a lot of money. And that's a lot of discipline to be able to save 20%. So this is hard. So remember, $10,000 a year took 31 years. $20,000 a year took 22. Guess how long this takes? It takes 18 years. It only shaved 4 years off of the $20,000 number. So investing is not what gets people rich. So what is what gets people rich? Now I have a third point here, so stick with me. But what gets people rich is time and having a base of money. You know, you take that same example. How long does it take to get to $1 million if you have $500,000? And if all you're doing is adding $10,000 a year, how long does that take you to get to $1 million? In that example, it only takes 10 years, right? So you've got that base. And that's what people are hoping for, right? People are hoping, here's the strategy that allows you to become a millionaire in 10 years. And unfortunately, it doesn't work that way. The numbers are just so big that you really need a big foundation and you need time on your side, which is why it's important to start early. And it's why there's a gentleman by the name of Charlie Munger, who is Warren Buffett's business partner. So they started Berkshire Hathaway together. Charlie just unfortunately passed away recently, but he has a quote, and he said, essentially, you have to do whatever you have to do to save $100,000. And then after that, you can ease off the gas a little bit. But what's often not mentioned with that quote is Charlie said that in 1994. So, $100,000 is not what it used to be. If you start with $100,000 and add $10,000 a year, it still takes you over 20 years to become a millionaire. That's not what people are thinking. So really, it's the base, I think, really starts at $250,000. And what's interesting is Charlie Munger said that quote. He gave a talk to the business school students at USC in 1994. I was in business school myself somewhere else at the time. And actually, Charlie came to talk to my business school in 1994 as well. So I did get to meet him, but he didn't give that quote. He used a cuss word in that quote. And I think one of his handlers said, "Hey, Charlie, you should probably cut that out." But $100,000 in 1994, inflation adjusted, guess how much that is? It's $210,000 today. So my experience being, boy, you really start to see things start to move for people after $250,000. So I'm going to rephrase Charlie's. This is Azul's phrase. You got to do whatever you got to do to save that first $250,000. And after that, Azul says you can ease off the gas a little bit. Okay, so that's the second reason is investing doesn't make anyone rich. Ready for reason number 3, and I hate to say this, but most people suck at investing. It's not just me that says that, right? There's a series of studies called the Dalbar studies that looks at how the individual investor does. What kind of returns are individual investors getting? And they look at various asset classes. So they study people's 401ks is how they get access to this information. And they look at, I believe it's 7 major investing categories. Gold, REITs, they look at the S&P. REITs are real estate investment funds. So just think of that as commercial real estate. So REITs. Then they look at the S&P 500. They look at international stocks. They look at bonds, and then they look at our homes. It's a 20-year study, and from 2001 to 2020, they looked at that, and the returns for those asset classes that I just shared with you are anywhere from 3.7% to 10%. So investors that could choose from those asset classes, guess how well the average investor did? Unfortunately, the average investor only did 2.9%. Now remember, the range of investments went from 3.5% to 10%. So how do you lose? Actually, there was an 8th category, which was oil, which was negative. So that's one way people lose. But the other way is just the market timing. It's just the way we're wired. We're chasing last year's winners, and we're staying away from last year's losers. So, the S&P 500 does really well, and so everybody piles into the S&P 500. Or gold does really well, so everybody piles into gold. Or commercial real estate does really well, and they tend to buy right at the high, and then they're stuck selling low, right? So it's a story as old as time. But what I want to point out is 3.5%, the range is 3.5% to 10. 3.7 to 10. And the average investor did 2.9%. And inflation during that period was 2.1%. So the average investor did not beat inflation by 1 percentage point. So the third reason why investing is not going to be the thing that lets you retire early is because, frankly, most people suck at investing. And I'm not saying that professionals have, an incredibly better track record. I think they do. But, there's been multiple studies that show that professional investors that are trying to beat the S&P 500, 90% of them don't beat the S&P 500. But I think professional investors, I think financial advisors, people like myself, I'm biased admittedly, but if people are underperforming at this level, that Dalbar calls that difference between what the S&P 500 did, in this case, what was it again? I think it was 7.5%. I didn't write it down, but I'm pretty sure it was 7.5% during this period of time, which is on the lower end of the range that the stock market does. I usually tell people 8 to 10%, depending on the time period that you use. So people underperformed by almost 5 percentage points. Let's just call it 4 to be fair. By 4 percentage points. That's huge. And Dalbar says it's because of market timing. They're chasing last year's winners and they're avoiding last year's losers. And they call that the investor behavior penalty. It's the penalty of our behavior as investors. And I don't want you to suffer from an investor behavioral penalty. Certainly not if it's a 4 percentage point drag per year on your portfolio. So none of what I've talked about in today's video is financial advice. And I do think most people, admittedly I'm biased, would benefit by working with a financial advisor that's a fiduciary to you 100% of the time. There's an organization of fee-only financial planners. There's other financial advisors that are fiduciaries to you 100% of the time. But I know of one organization that does that. But if you just Google fee-only financial planner, you'll find somebody near you. I also don't want this video to discourage you. So I want you to encourage you to watch this video here, which is 3 signs that you're likely much richer than what you think you are. So I think this video will be the pick-me-up from kind of the letdown of this video, that investing's not going to be the thing. It's all important, but it's not the thing. So watch this video here, 3 signs that you're doing much better. You're way richer than what you think. Thanks for watching this one. Bye-bye.